Hey guys, welcome back to the channel. If you watched my video yesterday, you already know the setup. A $1.1 billion buyer stepped in at the 422 level for Micron in the after hours. In today's video, we're going to take it one level deeper. We're going to examine and break down what that move and what that trade actually means for the stock. And as a reminder, let's just take a look at on Friday what we saw. Micron was down by $21, almost 5%. But in the final minutes of trading and in the after hours, $500 billion quietly moved through the market for Micron. And inside of that quiet move was a $1.1 billion buyer that stepped in exactly at the 422 level. And when I showed you guys that move on my channel, the reactions were immediate. On one side of the coin, we had viewers that were optimistic that this was a bullish sign. This was the whales stepping in and buying the dip. And on the other side, in the comments, I saw many people pushing back. Was this really accumulation, Kevin? Or was this just options activity, fund rebalancing, or a neutral cross that really doesn't mean anything at all for the stock? So today, we're going to slow down a bit because the real question isn't just what happened. The real question is, why would someone deploy $1.1 billion at that level at that exact moment? And more importantly, what does it actually tell us about Micron? And what doesn't it tell us about the stock? And what does it tell us about where the stock is going next? That's what we're going to break into on this video, what we're going to break down in this video. If you haven't done it already, hit like, hit subscribe to the channel. But before we get in and talk about that $1.1 billion trade, we need to understand the environment that it happened in, because this wasn't a quiet session on Friday. You can see on the board, there was red across the board. There was tons of macro headlines and geopolitical tensions and oil prices rising that had an impact on the stock. This was a high pressure sell-off across semiconductors. Look at the red across the board and all of the tech stocks, the semiconductor stocks. We saw weakness across memory. We saw weakness across many other tech stocks and sectors. And we also saw rotation out of high beta AI names. We saw funds de-risking as they headed into the weekend. And what did that happen? What that created is something very specific in the market. It created liquidity. And institutions don't chase strength. They wait for moments like this, moments where price is moving fast, sentiment is weak, and size can be executed without pushing the market further. So what we watched on Friday just wasn't price going down. It was a transfer of shares under pressure. And I want to address the pushback directly that was in the commentary, because this is where the conversation gets really cool and great for this channel. A lot of you asked the question of, is this really a bullish sign for the stock, or are we overinterpreting the data? And honestly, that's the right question to ask, because when you're dealing with a block trade at the size that we saw just minutes after the market closed, you have to be careful about overinterpreting or assigning intent to that trade. And so first, I want to talk through three issues that came up in the comments. Let's talk about the options argument. Let's talk about the rebalancing argument. And then let's just talk about the truth about cross trades overall. So first, at the idea that this could be tied to options positioning. That's absolutely possible. Market makers hedge constantly. Institutions adjust exposure, and sometimes that shows up as large prints in the underlying stock. But what's different about it, and what stands out to me personally, is that this wasn't fragmented flow. This wasn't price moving across multiple levels. What we saw at the 403 mark, just 3 minutes after the market closed, was two identical, remember I called them Godzilla prints yesterday, two identical back-to-back prints at the same exact price. That structure, more to me, looks more like a negotiated cross than reactive hedging. Now, does that rule out hedging completely? No. But in my opinion, it shifts the probability towards this being an intentional transfer of size. Market makers definitely influence the price action leading up to the close at 4 o'clock. But the after hours, they're typically a different beast. Market makers usually delta hedge during the regular session hours. Those billion-dollar prints at 403 suggest a strategic positioning for the next week ahead, not a hedge for the week that we just had. Second, I want to talk about the rebalancing argument. The idea that this was purely fund rebalancing is also possible. We know that Micron was added to the S&P 100 effective tomorrow, March 23rd. This means that hundreds of passive funds are required to buy at the close on Friday to match the index for Monday morning. But ask yourself this question: why did the stock drop 5% if there was forced buying? It's because the whales use that forced index demand to exit their own massive positions without crashing the stock to zero. We saw a total transfer of ownership from active hedge funds to passive index funds. The question we should be asking ourselves is, who got the better deal? Drop a comment below and let me know who you think got the better deal. Even if this was rebalancing, the execution of this trade still tells us something. The way it was executed in back-to-back blocks of 568, 8 seconds apart, suggests that large active desks were waiting to fill that forced demand. It was a moment of concentrated liquidity where a massive amount of risk changed hands without the price skyrocketing. And now let's talk about just the third factor, the truth about cross trades. This is the most important point that I want to call out, is that a cross trade always has a buyer and a seller. So when we look at a trade in the after hours, by definition, it's hard to say if it's inherently bullish or bearish because it has both. It doesn't tell you where the stock is going, but it does tell us where large capital is willing to transact. Now, to be precise, this does not prove directional conviction. It does prove that the size was willing to engage at that level under pressure. We have to also respect the other side of the trade, the seller side, because for every $1.1 billion buyer, there's a $1.1 billion seller. And on one side, you have potential forced sellers taking profits, de-risking. On the other side, you have buyers making a decision, a strategic entry point, reweighting, long-term positioning. And the truth is, the market is where those two meet, which means the 422 level wasn't just demand, it was also supply. Someone looked at that level and decided to exit. So what we're really seeing here is a transfer of risk between institutions. And some of you said that $1.1 billion seller was the smart one. But remember, sellers have to exit for many reasons. They may need cash, rebalancing, tax harvesting. But buyers only buy for one reason. They think the price is going up. And while the seller may be forced to sell by a client withdrawal, the buyer chose to step in with $1 billion at the 422 level. That choice is a signal. We have to remember that the $1.1 billion of supply being dumped into the close didn't break the price. Usually when a seller has significant negative conviction, they push the stock through the floor. The fact that the price held and continued to rise in the after hours up to 420.28 proves that the demand was greater than the supply. Even after saying that, you may still be listening to me right now and saying, Kevin, this doesn't prove direction. But guys, it does prove value. At 422, someone decided Micron was on sale, enough to risk $1 billion. That's not an opinion. That was a trade. The market doesn't give you certainty. It gives you signals. And our job as an investor isn't to be certain. It's to interpret signals within the market without overcommitting. So instead of asking, is this bullish? Was this a bullish trade? Let's ask a better question. What does the 422 level represent to institutions? Because they don't see what retail sees. Retail sees a breakdown, a red candle, something to avoid. Institutions see opportunity through liquidity. They see forward demand in AI, tightening memory supply, and most importantly, defined risk at a specific level. Because when a stock drops aggressively, it's not just down, it becomes available. Available at a price where size can be deployed, risk can be managed, and positions can be built without chasing. Think about it like this. Institutions don't deploy $1 billion because they feel good. They deploy because the risk reward is at the level that makes sense. So everything comes down to what happens next. What does this mean for tomorrow, for Monday? Because one print doesn't define a trend. Behavior does. If the 422 level holds, it tells you that demand is present and that the buyer or buyers like them are still active. If it breaks, then we have to reassess, like I mentioned, because then the question becomes, was that a real level at 422? Was it a real support? Or was it just a one-time transfer? Watch the open on Monday. Watch the first hour. Watch how the price behaves around that level, because that's where the truth will show up. The billion-dollar trade at 422 does not guarantee that Micron goes higher. It's not a signal to blindly buy the stock. And it's not proof that institutions are all in. But it is a signal that matters for Micron. Because in a moment of pressure, at an exact low of the day, a large capital was willing to transact at 422. And in markets, that's information. Not certainty, not prediction, but information, a signal. So going into Monday, don't watch the price. Watch the level, because that's where the next decision gets made. I'll see you guys at the opening. I'll be watching 422. I hope you're watching it as well. Have a great Sunday. See you.